Hello, hello. Welcome back once again. Looks like the markets were reaping today, especially China. And even after the Fed came back with an increase in interest rates, I guess that was expected since a long time now, the market still went higher. And even after the announcement, they went even higher than before. So a little bit of an unexpected behavior there. But I guess, the Fed had to increase the interest rates at some point just to battle inflation. Inflation has been creeping up higher and higher, and for me is actually my most important concern really. If we're talking about the economy and the stock market, would definitely be inflation. Yet today we had a fantastic day, and what I wanted to make a video about with this one, I wanted to talk a little bit about companies and stocks, and I'm getting this question a lot, and this is why I wanted to make a video and explain a few things about it. People are asking me in all sorts of comments, really, uh, should I wait for this company to go at that price in order to buy it? Or it will never go down as much as the model tells me to buy it at. What should I do? I mean, I want to buy this company, but it seems expensive and it will never reach that price. Should I just buy it? I mean, what's the proper thing to do in this situation? And this is why I wanted to make a video about it. And I'm gonna be using Netflix as one company of comparison here, and the other company that I will compare it with is going to be Intel, and I'm gonna explain why. Now, I found, I guess I found an occasion where I can actually showcase a little bit of what I'm working on right now. This is a social trends module and kind of showcases what's going on with Netflix. And that's yesterday's and today's social trends on stock tweets and Twitter. And you can kind of see what's going on socially. And this gives you an idea of the trends. That can be very, very interesting actually, and very useful in some situations, especially if you're a trader. That can be a very, very useful module here. Just wanted to showcase it. And another one that I'm working on right now, that's still a work in progress, is the stock analysis module. That's gonna be showing things about the company and also have a very nice breakdown of all sorts of metrics here. Again, this is a work in progress. It's nowhere near done. There's a lot of testing going on and a lot of new additions. There's going to be way more metrics here. But this kind of shows you, for instance, outstanding shares here and how they have been increasing or decreasing, or the price to free cash flow ratio, things of that sort, with included charts and all that. So it's going to be pretty awesome. I'm excited for those. But for this video, I wanted to use the stock evaluation tool. And with that, I wanted to show you what's the evaluation for a company like Netflix. And right now Netflix is sitting at $357, and it's been down quite a lot lately. Yet let's just say that we like the company and we want to buy Netflix. And we're like, okay, let's use the tool, and we're seeing that the revenue growth is this, the net income margins and free cash flow margins, these are the averages. And I actually added a fairly new module right now, which actually tells you what are the analyst projections. And these are the projections for 2022, and that's from 17 analysts here, the average one being at 12.8% revenue growth for the next year. So we can use all this information to compile our projections here. And I'm gonna go with, this is gonna be my average, I guess. So let's go with 10, 12, and 14 here for our projections in terms of revenue growth. And our net income margins should be based off of the previous years. And we're gonna go 10, 12, and 14. Again, that makes sense based on what's been happening. The free cash flow margins are a problem here for Netflix because they are much in the negative. The company has been losing lots of money. It's only 2020, which was a positive year in terms of net profit, and this is why you're seeing a positive value here in the free cash flow margins. I guess that's because of the pandemic, I suppose. And now here we have to be a little bit more confident, because otherwise we're gonna be getting much, much lower values, and it may not be indicative of what the company will be achieving. I don't want to overdo it though, because if I overdo it, I may be overconfident and actually get way off in terms of what's going to be happening with the company. So I'm still going to go relatively low. I'm going to go 30, 40, and 50. And remember, this is not growth, this is free cash flow margin. It's the comparison between free cash flow and net income. And the reason we're doing that is because we want part of the free cash flow to be part of, actually want free cash flow to be part of the net income of the company, because free cash flow that is positive and net income that is negative is not a good sign. We want our free cash flow to come from the profitability of the company, not from manufactured sort of metrics, like for instance stock-based competition, which surprisingly is positive in the cash flow statement. So be careful about these things. This is why this model kinda takes in, not kinda, for sure takes that into account. So if we use an annual return of 13%, which is what I like to use for the most part, we're gonna calculate and we're gonna see that we're getting a value of 40, 70, 112 for our high estimates, while the current price is sitting at $357. So as you can see here, somebody may come in and be like, okay, this is ridiculous, this is very low. The company will never reach this price. And this is when the question comes, is it about the company or about the stock? So the company is amazing, it's great. I mean, we all love Netflix. I actually have a Netflix account, I pay for Netflix. It's a great company, I like it. But do I like the stock? Hell no, I don't like the stock. I don't like the price of the stock. If the stock was some sort of paper, it used to be actually in the old days, then I could like it because it may be nice and has some nice pictures or something. But in terms of the company stock price, I don't like that because it's expensive based on what the company has been doing and will potentially be doing in the future. And this is also confident estimates, by the way, especially the free cash flow margins here is what is mostly confident here. And so as an investor, we want to be making the most money possible, having the least risk possible. And if we buy at 357, we are overpaying massively for the company. And so somebody may be coming in and be like, okay, I want to buy Netflix, but this will never happen. It doesn't make sense to me. So my response to that is, if it doesn't make sense, you don't buy it. And you're sure are right. It doesn't make sense because it is overpriced, and this is why you should avoid it. Now, if you don't want to avoid it, it's of course your decision. But mathematics and the formulas here, and this is all about the free cash flow and the operations of the company, the net income, the revenue of the company, how much it's growing. It takes into account all these things. Tells me that the company is expensive at its current valuation. And you can of course get it from other metrics. For instance, get an idea of it, which is not definitive, of course. Like you could, for instance, use, if I go back to the stock analysis tool, you could actually use the PE ratio, which is also overpriced here. And it used to be much higher even, as you can see here in the charts. The company has lost a lot of its value. This is why it's lower now. But net income can also be skewed by a lot of things like depreciation, which is a big thing for a company like Netflix. And this is why we need to take free cash flow into account. And now I wanted to jump into a different company. Let me actually load it and I will come back. So now we're going to take a look at Intel Corporation, which is another very well-known company. And this one, you will see here that it does have a low PE ratio of 10. But again, this is not the end-all be-all. This is a good sign, but we do need to run our stock evaluation tool. And now let's picture again the scenario where we're looking at Intel and we're like, okay, I'm interested in the stock. Should I buy it? Okay, let's run our calculations and see. The revenue growth of the company has been 3.7 and 1.49 in the last 3 and last year consecutively, really. And then you will see that the average analyst projections are sitting at 3.5, which is about what the 3-year average is. And so what we're going to do is use 2, 3, and 4 here, which is what makes the most sense, right? The net income margins are about the same, which is nice because they can help with our projections. We're going to go 22, 23, and 24 over here. And the free cash flow margin, look at this company, for instance, and compare it to Netflix. Netflix had a lot of minuses here. Do you see that with Intel? No. That's because Intel is actually making profit and is actually converting some of this profit to free cash flow. That's what you want to be seeing out of a regular company that's doing well. So free cash flow here, the margin, we can use something like 40, let's go 50 and 60. And the annual return of 13, 13, and 13. And now we're going to calculate here. And we're seeing that, again, we are slightly in the red for our high estimates, but the current price of the stock is at least relatively close to the max price to pay for our high estimates. And the medium estimates are 33.7, the low ones are 24.75. And so now you see that with regular projections here and conservative revenue growth, we're getting a figure that is about $33 to $44, which is again relatively overpriced to what the company is doing right now, but it's much closer than Netflix. This would require like a buck or two to enter our high estimates. And now for this one, I would want the company to be around 35 potentially, maybe mid in between these two levels over here. Just because these projections here are very normal. I think that the company can achieve. I think that being around 35 potentially is probably where I would want to get this company at. And another company that we can also take a quick look at, and again, let me load this one, and that would be Facebook here. And again, we have the information for Facebook all loaded up. It's today at $203, being up quite a lot today, I believe, significantly. And let me actually check that. I think it was like 6% at some point. Let me quickly check that. 203. So yeah, 6%. Yep, let me go back. So the estimates that we're going to be using here. Now we are seeing that the revenue estimates for the average projections here are 3%, which I think they're fairly conservative here. Probably very conservative for Facebook. I don't think that Facebook will have this kind of yearly, annual revenue growth. I think that's very little here. However, I'm gonna go conservative. I'm not gonna go that conservative. I think 3% is a little bit ridiculous here. And so I'm gonna go 10 still. I'm gonna go 10, 15, and 20. I think Facebook will probably be at around 15 to 20, to tell you the truth, for the next 5 years, because this is what the tool is actually projected. And the net income margin that I'm gonna be using, these are all fairly similar, so I'm gonna go 30, 31, and 32, and still be below most of these values. And the free cash flow margin, again, another company that has very similar free cash flow margins. I'm gonna go 90, let's go 93, and 90, let me fix that, 90, 93, and 95 here. And the annual return, always 13, for the most part. Now, if a company is more risky, I like to have it like at 14 or 15 maybe. But I'm gonna calculate here. And now look at this company. Now we are seeing a company that today is actually worth less than even our lowest estimates here. And this is how I would evaluate a company regardless of the name of the company. I'm taking a look at what they're doing in terms of financials, what they're doing in terms of how much money they're making, and then I'm directly comparing it to the current price of the stock, and using my low, medium, and high estimates, I'm finding which one of these scenarios make the most sense. And if my lowest scenario is actually fulfilled here, this would be my top choice. And now I have analyzed 3 companies here, and I have an exact way of knowing how to rank these companies. So we examined Netflix, Intel, and Facebook. And in order of precedence, really, in order of which one I would prefer, in order of preference, the first one I am preferring is obviously this one, Facebook, of course, as you can see. The second one is obviously Intel, and the third one would be Netflix, which I would probably avoid as a whole. And so you see that in the question, does the stock come first, or did the stock come first or the company? Well, I guess the company comes first, but if we're talking about purchasing the stock, we're taking a look at the stock as well, but first examining the financials of the company. We're not looking at the stock individually. We're not looking at the price of the stock and be like, okay, it's 50% down, let's go buy it. It doesn't work like this. We're looking at the company, and we are like, if the intrinsic value of the stock is 50% down, then I'm buying it. But that intrinsic value is based off of the company's worth and the company's financials. And this is what I wanted to point out in this video. I hope you enjoyed it a little bit and it helps you, potentially think about and rethink about some of your fundamentals and some of the opinions and ideas that you have about investing. And in case you haven't done a lot of value investing and fundamentals research, you now know a few more things about it and you can keep on doing your research. And if you enjoy this kind of content, you may want to subscribe because I'm creating all sorts of content about this type of investing and analysis. And I think that can be very beneficial for you and your investing. And if you like this video, please leave a like. That's completely free and it really helps the channel grow. And thank you for watching this one. And if you enjoyed this video, take a look at this one that I made earlier, and it discusses the Alibaba of today, which actually grew at about 37% or something at the end of the trading day. Insane. Thank you for watching this one, guys. See you soon. Bye-bye.